Okay. Good evening and welcome to FSM1 webinar on navigating the tech cycle, opportunities and risks in volatile market. So my name is Mark. I'm a client investment specialist from FSM1 CIS team. First of all, I'd like to thank all the participants who registered and joined the Wednesday evening webinar today. Okay, so for now, right, it's all about big techs. So we are seeing a more attractive entry points in some of the world-leading technology companies, while the long-term AI and cloud growth story remain intact. So for our investors looking to take advantage of this opportunity, there is currently our ongoing campaign. Uh, our campaigns here. Our ongoing campaign offering a zero sale charge plus 0.3% bonus unit for every 1,000 net investments up to RM 600 until 28 August 2026. So when you invest in a Maybank Global Sustainable Technology Fund, which is available in MYR, MYR-aged, and USD classes. So for all the details and full terms, just log into your FSM1 portal and you're able to find those informations. Okay, so during the webinar today, if you have any question, feel free to put your question in a Q&A tab, and then our speaker will address the questions later. Okay, with that, allow me to introduce our speaker, Mr. Jim Lim, global equity analyst from Maybank Asset Management. So Jim Lim is covering semiconductors and technology, hardware technology within the global equity team. He contributes research and idea generations across global technology supply chain for the firm global equity strategies, including uh, including the Maybank Global Sustainable Technology Fund. So he's a CFA chartered holder. So without further ado, let's welcome Mr. Jim Lim.
Hi, thanks, Mark, for the introduction. Hi, everyone. Just give me a second as I share my slides. All right. Mic is on. You can hear me, right, Mark?
Yes, your sounds
Okay,
clear and slide also good. Okay, so
great.
yes.
Okay, sounds good. A very good evening, everyone. Thanks for dialing in, on a Wednesday evening. As Mark said, my name is Jim. I cover semiconductors and hardware tech here with the global equities team at Maybank Asset Management. And today I'll be mainly talking about the Maybank Global Sustainable Tech Fund, and I will walk you through the outlook on each of the subsectors within tech as well. Now, this fund is advised by Lazard Asset Management. So for those of you who don't know, Lazard is one of the world's leading financial advisory and asset management firms. As of end of June 2026, their assets under management stand at about 285 billion, and they have operations globally. And on this slide, you can see the investment team at Lazard that is in charge of this fund. And it's clear that they have extensive experience in this industry. But what's important to note is that this fund is not purely reliant on their expertise and knowledge. We also have our in-house investment team here in KL, such as myself and my fellow investment analysts and fund managers, where we add our inputs and views. So moving on, I would like to just briefly walk you through the fund performance so far. And just keep in mind, all the statistics that I will quote in this presentation are as of end of July. So year to date, until the end of July, in USD terms, the fund has returned about 16%. And as of today, I think it has risen a few more percentage points, given that markets have rebounded so far in August. So you may be thinking, wow, year to date, despite US tariff threats, despite what's going on in the Middle East, the fund has performed so well. Yes, and a large part of that strong performance is because tech in general has been performing very well year to date. And we can see from this chart right here, and the top line right there is a QQQ, which is an ETF of the Nasdaq 100. So it's basically it represents tech performance. So tech in general has been outperforming the broader market, S&P 500, not just not just this year, but over the last 16 years, as we can see from this chart. And in fact, if you remove the tech components, the technology stocks from the S&P 500 basket, that basket underperforms the actual S&P 500. And this goes to show that technology has been a key driver of share price returns over the last 16 years. Now, why is that so? Oops. Now, this is because tech companies have been delivering very strong return on equity. In fact, from the top chart, you can see that the return on equity from tech stocks has generally been stronger than almost basically every other sector in the S&P 500. And not only that, the forecasted earnings growth over the next 12 months of these tech companies are also much stronger than every other sector in the S&P 500. Now you may think, wow, tech stocks are delivering very strong earnings growth. But then during each quarter's earnings, the tech companies are telling you, no, we're doing much better than you think. And so that leads to sell-side analysts upgrading their earnings estimates numbers, and that leads to more flows into technology stocks, which is why tech stocks, and that's what's been driving the strong performance of tech stocks. So I'm sure you're wondering, and I'm sure you get these questions a lot as well, like some of these tech stocks or many of these tech stocks are already at or near all-time highs. And is this sustainable moving forward? So we strongly think so. And this is due to the strong outlook across the various subsectors that the fund invests in. Now, let me walk you through how we're thinking about the outlook for the rest of 2026 and into 2027, and hopefully answer any burning questions that you might have in mind. So, broadly speaking, we're still positive across the various subsectors in technology. The AI infrastructure build-out is continuing very strongly. The hyperscalers, such as the big tech companies that you often hear of, such as Microsoft, Google, Amazon, Meta, and other cloud providers such as Alibaba or Oracle, they're collectively forecasted to spend over $1 trillion in capex to build AI data centers in 2027. And that amount is expected to only continue growing in the coming years. And this is creating attractive opportunities in the picks and shovel stocks, such as in semiconductors. And I'm sure you've heard a lot about that, or you've read a lot about the opportunities here. But we also see abundant opportunities in the AI enablers and the AI adopters, because we think that we are only in the early stages of AI monetization, as you and I and companies are only still trying to figure out how to incorporate AI into our existing day-to-day workflows. So we remain very positive across all these segments, including semiconductors, hardware technology, cloud service providers, as well as software. So let me just check that everything is fine. Okay. Now let's dive deeper into each one of these segments. And I want to start with the hyperscalers. And hyperscalers make up about 29% of the fund. So again, these hyperscale companies are the spenders and the infrastructure providers of this AI era. They own the data centers and they provide the cloud service or social media service such as Facebook or Instagram. But these companies have been under tremendous scrutiny for spending so much on building AI data centers. Investors are wondering like, hey, you're spending hundreds of billions every year, and next year you're going to spend over $1 trillion altogether to build these AI data centers. Are you actually earning a return or a profit on your spend? And so, over the last few quarters, whenever you see that investors don't believe that they're earning that return, and yet they continue to bring up their expectations of capex forecasts, their shares get sold down. But we see it differently. We're seeing concrete evidence that these hyperscalers are earning a very attractive return on their AI spend. And I want to bring your attention to the next slide. And you see the chart on the left-hand side shows you to year-on-year cloud revenue growth of some of the biggest hyperscalers. So this shows that each and every quarter, the year-on-year revenue growth rate of their cloud service is only accelerating. So for example, in third quarter 25, Google's cloud service was growing at 39%. But in the most recent quarter, it's growing at 82%. And this is already from a pretty large base. And the fact that these giant tech companies are still growing at such a rapid clip is pretty amazing. And to us, that's concrete evidence that AI is generating, some form of real return. And not only that, they are becoming more profitable as well. So not all of these hyperscalers release the margin profile of their cloud service, but the two that do, Amazon and Google, have shown clearly that providing cloud service in this AI era is becoming increasingly profitable. You can see the consistent increase in their margins over the last few quarters. So revenue growth is accelerating, margins are expanding, and not only that, the backlogs are exploding. So what we see here is that again, over the last few quarters since I think the iPhone moment of AI when ChatGPT was released, um, the the backlog of the hyperscalers has grown 3 times the amount of what the hyperscalers have spent. So this means that every time hyperscalers spend like say $1, you're basically earning 3 times the amount in your backlog. And this is again very strong evidence that they are earning this is translating into bookings that they will have to fulfill in the future, and this is future revenue. So all of these signs point to, in our opinion, point to very strong return on their AI spend. Now, market may still be worried, because all of this capex that the hyperscalers are spending is eating into their free cash flow, which has recently turned negative in the last few quarters. And investors are wondering whether this will persist for many quarters to come. But we're not really worried because we think that they are investing today for attractive returns tomorrow. Now, going back to the numbers that you see here, the accelerating cloud revenue growth, they're basically reaping the fruits of their labor that they have put in about a year or two ago. I mean, they made the capex investments a year or two ago, and today they are seeing the acceleration in their revenue growth. So whatever they're spending on today in the second quarter and third quarter 2026, they expect to see the returns of that in 2027 and 2028. And the fact that they're still spending so aggressively today they're basically telling us, hey, we need to spend on this because this will drive very strong earnings growth in the coming years. And furthermore, we're all using more and more AI every day, and this is driving greater need for computing capacity, which is exactly what they're building the AI data centers for. Now, let's move on to the next subsector, which is semiconductors and hardware tech. And I want to bring you back again to this slide, because at the bottom, you can see the commentary from each of the executives on just how supply constrained they are. These hyperscalers are trying to like sell more cloud service, but they just don't have enough capacity because there's just bottlenecks all across the semiconductor supply chain. So semiconductors and hardware technology, these two subsectors, they make up the biggest portion of this fund, at about 57% of the fund, because these guys are clearly the biggest beneficiaries of the AI infrastructure build-out, as they provide the brains of the data centers. Now, within semiconductors and hardware technology, there have been numerous structural themes happening at the same time, and these are all driving very powerful earnings growth in the sector. So, for example, memory has gained growing importance in improving AI systems processing ability. CPUs are important again. I mean, we all thought, oh, AI era is just a GPU play, right? No, CPUs are becoming important again in the agentic AI era as they play the important role of orchestrating workloads. And then networking is becoming crucial to reduce latency and to improve the GPU utilization rates. I mean, if you have two like very strong, powerful NVIDIA GPUs, but then the networking between them is not very good, you're not fully utilizing the GPUs. So the networking here is very essential to make sure you get the bang for your buck on everything you spend on the GPUs. And then custom AI accelerators are helping the hyperscalers reduce their reliance on NVIDIA GPUs. For example, Google is designing their own TPUs, which is custom made for AI, essentially designed by the Google team. And this is allowing them to build computing capacity at a fraction of the cost compared to just buying from NVIDIA. Additionally, leading edge logic and memory foundries, such as Micron and TSMC, are investing in carefully expanding capacity. And this is driving demand for chip making equipment, such as those from ASML. But across all of these themes, there's one consistent message from all of the companies. Demand far exceeds supply for many years to come. There are very pronounced shortages across various parts of the supply chain, and this demand and supply imbalance is transferring pricing and negotiating power to the suppliers. Now, because demand far exceeds supply, and the hyperscalers really need the chips to build their computing capacity in their data centers, the chip buyers, i.e., the hyperscalers, are giving the chip suppliers order visibility over the next few years. Now, historically, chip suppliers like NVIDIA, AMD, TSMC, they don't get such long visibility. They just see a few quarters out. But now their visibility is extending multiple years out because the buyers and the sellers are striking long-term agreements that are several years long, giving the semiconductor suppliers confidence that the strong demand will persist through to the end of the decade or even beyond that, like what I've been hearing from Western Digital. And because demand far exceeds supply, chip suppliers are increasing prices. And the hyperscalers, they're willing to pay up for it because they're just so desperate for the chips to add to their computing capacity. And what's amazing is that much of these price increases flow straight to this chip supplier's bottom line. And this is boosting the semiconductor company's profitability. So, as a result of these structurally favorable trends, we are positive across the whole semiconductor and tech hardware supply chain, from logic foundry to memory to chip making equipment and even the hard disk drives. Now, moving on to the next subsector, excuse me, and this makes up about 18% of our fund, software. Now, software, unlike hyperscalers and semiconductors, face a very different backdrop. Investors are worried about AI disrupting the business models of software companies, driving an almost existential crisis. AI has turned virtually everyone into a coder. I mean, I'm sure you've heard of the term vibe coding, right? If you really try, you could use AI to develop your own software or your own applications. So investors are rightfully worried that AI could reduce the importance of software companies in an AI era, which is why year to date, software stocks haven't performed as well as the market and nowhere near as well as the semiconductor stocks. But we see it differently. We think that the sell-off across all of software has been indiscriminate and does not reflect the improving fundamentals of some of the companies. Yes, application software companies such as Salesforce and Adobe, in our opinion, may be more prone to AI disruption, but not all software companies are subject to the same risks. With software stocks having lagged the broader market year to date, we see lots of attractive opportunities. And we still like the space. We are just more selective here. In fact, we think that AI is a tailwind to certain buckets of software companies. For example, AI is making software development even cheaper and is driving accelerating metrics in some of the software companies. Microsoft, in their most recent quarter, showed very strong seat growth, with net seat additions more than doubling quarter on quarter. And ServiceNow's AI revenue crossed $1 billion in annual contract revenue for the first time, and they cite customers' agentic deployments have 9x in 9 months. So clearly, adoption of their AI products are very strong. And furthermore, in an AI world, cybersecurity is becoming more important than ever. AI has created many new methods of cyber attacks, and thus, there's a greater need for companies and individuals to protect themselves with cybersecurity software. And moreover, the more enterprises deploy AI, the more they need to use cybersecurity to have oversight over their AI. This is to prevent AI from wreaking havoc and causing irreversible damage to an enterprise's database. So, all in all, there are a lot of opportunities within software, and we still like the space. It's just that we are more selective. So, I've walked you through each of the three subsegments or all of the subsegments within technology. And yeah, everything sounds great, right? But I know many of you have very valid concerns about whether all of this is just an AI bubble. I mean, share prices are kind of going through the roof, and you're like, hey, this is kind of reminiscent of the dot-com era. So the question that I get the most is that, hey, is this whole AI build out just a bubble, just like the dot-com era was? And the answer is no. We see several key differences in today's build out versus that of the dot-com era. So, first of all, during the dot-com era, investors were piling into stocks, any stock with a dot com at the end, even if they didn't understand the business model or even if the company didn't have much revenue. But today, that is a very different scenario. The AI labs, such as Anthropic and OpenAI, have real products. I mean, you and I are using, I think I can safely assume that you and I are using one AI model some way or another, like Claude, ChatGPT, or Gemini. And these companies like Anthropic and OpenAI, they're earning real revenues from this and they're seeing very strong growth. And second of all, during the dot-com era, the telco companies that were funding the network build out, they were funding that with debt. Today, the hyperscalers are funding these build out with their very own operating cash flows. Yes, they are starting to dip into debt as a form of financing, but debt is still a very small portion of the total AI spend. And third of all the networking infrastructure that Cisco had built in the dot-com era, they were pretty underutilized. I mean, they were all built in hopes of future demand from the internet. But today, all of the chips that are being deployed in the data centers are running at very high utilization rates, and which is why you continue to see GPU rental prices continuing to climb. And all the compute users, all the AI labs, all the hyperscalers, they're continuing to say they are capacity constrained, which basically means, if we had more chips, we could be earning even more revenues, which is why we need more chips. And very importantly, all of that revenue that's coming in into the actual tech ecosystem is translating into very palatable multiples. So if you look on a chart here, the valuation of the top seven tech companies back then during the dot-com era, they were trading at an average of 67 times forward earnings. Today, that figure is only at 26 times, which is very palatable compared to the borderline unreasonable valuations back then. So to wrap things up, today's infrastructure build-out is very different than that of the dot-com era. And then a similar question, and one that closely relates to what we just talked about, is, what if the hyperscalers overbuilt data center capacity? Okay, yes, this is a real risk, um, but we don't think that's happening anytime soon. Because right now, demand continues to grow at a rapid pace. What we're hearing quarter after quarter is that demand for AI computing capacity continues to exceed expectations. And a lot of this is driven by AI labs, both the Western models as well as the Chinese models. And the fundamental lack of chips, and especially the lack of power, makes it very hard to even bring too much capacity online. I mean, we're not even bringing enough capacity online. How are we going to bring in like too much capacity online? And what's important to note is that the chip suppliers are being very disciplined about increasing supply as they are slowly adding capacity because I mean they've learned the lessons from the past. Like during COVID era when everyone suddenly wanted a new computer or a new smartphone, and then they overbuilt chip making capacity, and then after that, when interest rate went up and all of us had replaced our new devices, we stopped buying computers and phones altogether, and then there was an oversupply of chips. So now they know. Now the chip makers are smarter. They know not to add too much capacity too quickly. They'll do it slowly. Anyway, they're in no rush. They're earning, I mean, pretty crazy margins, and they're seeing very strong profitability nowadays. So they're enjoying this and slowly adding capacity. And not only that, on the power side of things, it takes a long time for additional power to come online due to regulatory hurdles and very long lead times for some of the essential components, such as those that you need for gas turbines. And the most convincing data point of all is that all of the compute users continue to see capacity shortage. Now, if there's like excess capacity somewhere, it will likely be absorbed pretty much instantaneously. So we're convinced that AI infrastructure build out is multi-year long and that AI monetization is only just getting started. So our portfolio in the Maybank Global Sustainable Tech Fund is positioned accordingly. And let me just briefly walk you through the portfolio construction. And I would like to bring your attention to the sector allocation at the right-hand side. So the portfolio is heavily skewed towards the enablers, and mainly in semiconductors and hardware tech. And within semiconductors and hardware tech, we have exposure across the supply chain, from leading edge foundry like TSMC to fabless chip designers such as NVIDIA, Broadcom, AMD, to the equipment that's applied to TSMC, such as Applied Materials and Lam Research. Of course, there are memory names in there as well. We also have exposure to the hyperscalers, which in this case are categorized under consumer discretionary as well as communication services. And importantly, we also have exposure to the AI adopters, such as those that will monetize AI, such as the software companies. And the geographic location is a result of our stock selection, essentially. And you can see that in the top 10 holdings of the portfolio. So that's it from me. I think I've talked for about almost half an hour, and let's get to Q&A. I think if you have questions, you can, Mark, correct me if I'm wrong. Are they able to use the Q&A function?
Yes, Mr. Jim, maybe you can click the tab, the Q&A, and you're able to
Okay.
see the questions there.
Okay, let me just,
Yeah. And also there is some question in our YouTube, which is we post in the chat. Then also you maybe can have a look on that.
okay,
Yep.
sure. Uh, okay. With the valuation of hyperscalers and many US company stocks stretched, Asia, like Korea, Taiwan, technology sectors are still very attractive. Which region will have higher upside in the next 12 to 18 months? Um, we don't have too strong of a view here, but I would be inclined to say we prefer, I mean, based on the geographic allocation here, it's clear that we prefer the Western markets, such as the US and the Netherlands. Because I guess in Korea, I'm not quite sure if it's fair to, but Korean market is largely dominated by the memory makers, especially SK Hynix and Samsung. And yes, their PE multiples are definitely still much lower than that of the average. I mean, they're trading at something like 3 or 4 times PE only, forward earnings. And so you may think, okay, well, that is tremendously cheap compared to some of the stocks that are trading at 20 to 30 times. So there is, yes, I don't deny there's room for upside, especially from a multiple re-rating point of view. They should be trading a much higher PE. I agree. But I think over the next few quarters, it may take market some time to recognize that and to agree that these stocks do indeed deserve these memory stocks do indeed deserve a high multiple. This is because currently among among the investment community, there's a concern that, oh, the DRAM and NAND ASP increase has peaked, and so this may be peak memory. Even though I disagree with that view, but that's the ongoing narrative, which is why you're seeing some headwinds on the memory stocks. So maybe over the next 12 to 18 months, I don't know when the narrative might shift, but it's very hard to say on these sentiment things. But I think X memory, my personal view is that X memory segments in the semiconductor and hardware space may be more attractive and may see clearer room for upside, especially in earnings revision compared to the memory stocks. Moving on to the next question. From the MGSTF fund holdings, it has high weightage on hyperscalers and Mag 7. What is so special in this fund as compared to other top technology funds? What is and how is the possibility of this fund can outperform the rest of technology funds in the next 12 to 18 months? I think what you don't see beyond the top 10 stocks is the long tail of other stocks. And I think there are some really good picks in there. And I think it is the tail end of the holdings within this portfolio that could drive the potential outperformance. Yes, you're right. If you look at most of the tech funds, it's basically the same top 10 holdings, right? I mean, we all roughly know the names, but it is the rest of the names that I have pretty high conviction in, that I think could drive outperformance. And I like that the portfolio has pretty heavy weight in semiconductors, which my team and I are still very positive on. Will we experience another deep seek moment? Kimi model is here, and cheap compute will be derailing the business case for the US. Um, no, I don't think so. So maybe I can brief you guys on what the DeepSeek moment is if you don't know what it is. So basically, I think earlier in 2025, um, a Chinese lab, DeepSeek, released their open source R1 model, and it showed that essentially you could generate AI tokens at a fraction of the cost of what the Western labs were doing. And so this made everyone panic, like, oh my God, we actually don't need so much computing capacity to generate these AI tokens. And so that sent shockwaves through the industry. Nvidia and other chip stocks tanked, and we thought we didn't need so much computing capacity. We thought we didn't need so much data centers. Um, and you would have thought that, the total amount spent to generate tokens, i.e., the spending on GPUs and semis and hardware would have fallen. But no, actually quite the opposite happened to everyone's surprise. In fact, after that incident, demand for tokens went through the roof. And demand for chips as a result also skyrocketed. And this is essentially called Javon's paradox. Um, because the paradox states that when a resource becomes cheaper, the total value consumed of that resource basically increases. So you might think, oh, it's so cheap that, the total value consumed of chips and computing capacity will actually reduce. But no, because it is so cheap, you are using way more of it. And everyone is like, oh my God, I have a lot more tokens now at a fraction of the cost. Let me generate more cat videos or, use Claude to do absolutely everything for me, to do my PowerPoint presentation, do my models for me. I mean, and then the use cases just explode because it is now so much cheaper to use AI essentially. And so that resulted in a spike in not just a spike, actually, a sustained increase, even up to today, of token demand. And so essentially, if there's another development in the future that makes AI even cheaper to use, that's very bullish. Not just for the semiconductor companies, but also for the adopters. It's cheaper for software companies to use AI to accelerate their revenue growth and to develop new AI products, essentially. Um, It sounds like many of these companies' capex are the revenue of each other. If one of them stops spending, would it cause a negative trickle-down effect and cause a downward spiral? Well, it is true that if the hyperscaler, yes, the hyperscalers spending equals the revenue of the chip companies, essentially. That is true. So the key watch point of whether the chip companies can continue to grow their earnings is whether the hyperscalers continue to increase their capex year after year, which is why this chart right here is so powerful. We can see that, yes, thus far, every year, hyperscalers' capex continues to increase. And there are lots of questions about when is the peak? When will the hyperscalers finally reduce their spending and reap the fruits of the rewards? No one knows, and we don't know either. But what we are watching out for is the commentary from the hyperscalers. Now, why would the hyperscalers continue to grow their capex spend year after year? It is because they're seeing attractive returns in 2027 and 2028. If they weren't seeing that, they wouldn't be spending so much. So we are very closely watching their commentary and what they are thinking about their return on on their capex spend, which is why again I bring your attention to this. This is very encouraging. I mean, if I was running Amazon or Google and I see these numbers, why would I stop spending? It's like kind of shooting myself in the foot. So as long as the trajectory is that of accelerating revenue growth and expanding margins, we think that the hyperscaler CapEx will continue to grow, and that translates to more revenues and earnings growth for the semiconductor companies. What are the key risks of this AI boom? If we have to be cautious, what should investors look out for? Um, yeah, there are a few key things, and I think the number one risk is policy risk. And it is something that, I'm keeping a very close eye on. And what do I mean by policy risk? You may have heard that in the US, it is becoming increasingly politically unpopular to allow data centers to be built in your state because it is supposedly polluting the waters, drawing a lot of power, and therefore increasing the residents' energy bill. And generally just creating a lot of, I mean, in some instances, if you have like a power generator in the backyard of the data center, it's going to generate a lot of noise as well. So it is increasingly unpopular. And if that translates into policy where, state governors or at a state level, they start pushing back data center timelines or they start canceling data center projects, I think that could be a negative. So we're keeping a very close eye on that to see if that could translate into a temporary build up in inventory of chips um, in the hyperscalers because they're just unable to build because they just can't get the regulatory permits. So that's a key risk. And then the second risk is if supply increases much faster than expected. And this would happen if the chip suppliers forget the lessons of the past and suddenly spend a lot to build their chip making foundries, and then suddenly you no longer have a chip shortage, and then next thing you know, there's an inventory oversupply. There's oversupply of chips, which leads to too much inventory buildup, and then this will not be good. So investors should keep an eye out on the semiconductors inventories as well. Let me go see more questions. In view of the Chinese model pricing being relatively cheap, will this be a concern for the hyperscalers, especially their dependence on OpenAI and Anthropic? He estimates OpenAI and Anthropic together account for roughly 70% of AI-related revenue at Microsoft, Amazon, Alphabet's Google, and Oracle, and 25 to 35% of those companies' cloud revenue. Um, yes, that is something to keep an eye out on. But this brings us to tokenomics essentially. And the key takeaway from here is that not all tokens are equal. Yes, each token from Chinese models are significantly cheaper. Like they're at a fraction of the tokens you get from using Claude and ChatGPT. But those tokens are not as good as the tokens from Claude. So there have been tons of research out there that show that to to perform the same task, like to complete the same task to equal qualities, you need significantly more tokens from the Chinese models than you do from the Western-based models. And then, if I recall correctly, the total spent to achieve that task is actually lower using the Western-based model relative to the Chinese models. And so this tells us that, it on the surface it seems like a threat to the Western models, but they're just some tasks that perhaps is not economical to use the Chinese models. At the end of the day, you still need the leading edge, the frontier models from the West, such as those from Anthropic and OpenAI. And I also heard about this potential future where you can think of the frontier models from the Western frontier models, like the CEO of a company, and then the Chinese models as the staff working under the CEO, where the harder tasks, those that require significantly more planning and thinking, could be performed by the frontier models, and then the perhaps lower level tasks may be performed by the Chinese models. Now, this is obviously a generalization, but if this were to happen, then there is still very strong demand for the tokens from those of the frontier models in the West. Let me see the questions. I noticed that majority of your slides briefed about the market, and what you have been saying is what we can get from the fact sheet. Okay, is there more info we can get from your fact sheet, such as what is your fund strategy going to be in the next 6 to 12 months? Um, so okay, our outlook on the next 6 to 12 months is our outlook is similar to what Lazard sees it as well. I mean, we think the hyperscaler CapEx will continue to grow year on year, and the pricing power and the negotiating power still is very much tilting towards the semiconductor suppliers. And so we're still very favoring semiconductors and hardware technology. And at the same time, we think the market is underappreciating the hyperscalers. I mean, you see these numbers on my screen right here. I think it's only a matter of time before market overlooks the negative free cash flows and start to appreciate the improving fundamentals of the hyperscalers, which is why we're still very much heavily exposed to the hyperscalers. And we think that, I mean, we don't think, we see that the software companies are seeing improving AI metrics. It's just a matter of time before the market starts to appreciate that. I mean, that's already happening with a handful of software companies like Snowflake, and Datadog. And we think over the next few quarters, the market will continue to appreciate what AI is doing to some of the software companies as well, like ServiceNow. The rate of CapEx spending being revised upwards are slowing. Do you think that's a sign of exhaustion, that the bull run for memory and hardware is ending? At least the end is already in sight, but not quite there yet. Yeah, that's a very common concern. And it's the concern about, oh, the second derivative is now starting to plateau. So are we near the peak of the cycle, essentially? I mean, I think that's what the question is trying to ask. Yes, that is a valid concern, but no, I don't think it is. I don't think we're near the peak of the cycle. Because the growth rates just continue to be revised, I mean, upwards. So heading into the year, I mean, what we see from the chart right here, Heading into the year, market thought CapEx was going to be 687 billion for this year and 842 billion for next year. But we're 8 months into the year, and these CapEx numbers have already been revised up quarter after quarter. So it is still being revised upwards, and that means the reality continues to exceed what the expectations are. And I think as long as that continues to happen, there's still upside. And plus, in July, there has been somewhat of a pullback. And I know August rallied again. But that pullback, and I think stocks sold off last night as well. I mean, all of these minor corrections basically are healthy resets to the expectations. And I think these are attractive entry points, especially if the earnings are going to continue beating over the next few quarters and into next year and probably well into 2028. Um, so I wouldn't say the end is quite near, but maybe it is fair to say that you may not get the as steep of a upward earnings revision in estimates, as well as perhaps a share price rally as we did between 2023 and where we are today. Which is why the portfolio is not just 100% in semiconductors, because we know that's a risk. And we know that that day will come when the outperformance shifts from semiconductors to the hyperscale companies as well as the software companies. And obviously, we as well as Lazard are keeping a very close eye on this development. And it's our job as portfolio managers to make that pivot when the time comes. Because when the time comes, it will be the software companies and the hyperscale companies that capture the economics. And that's when the hyperscale companies may pull back on their CapEx spend, and that's when software and hyperscale companies outperform the semiconductor companies. I think for some of these questions, I've already addressed them indirectly, such as, what's the fund strategy in the near term and long term? Um, yeah, I hope that's been clear throughout my presentation. Between investing in your fund versus a QQQ ETF, any difference in the risk? So the QQQ ETF is ETF of the Nasdaq 100. So obviously, there's significantly more stocks in there relative to what we have in this portfolio. And this portfolio is a more concentrated bet on all these themes that's happening in the technology sector. But one thing to highlight, and I didn't talk much about this, is that this portfolio also has exposure to financials companies, which you don't really get in a QQQ, or at least not as much of. And within financials, in fact, financial companies are one of the key beneficiaries of AI adoption. I mean, just think of banks. They have a lot of things in banks that you can use AI to automate. And hopefully that over time drives lower non-performing loans as well as just generally better cost savings, so better margins overall. So that exposure is one difference between us and a QQQ. But also having this fund being actively managed allows us to capture the inflection points within the different themes. So like what I just said just now, when there is an inflection point that shifts the outperformance from semiconductors to the software companies, we will be here to hopefully capture that rotation. Hopefully that answers your question. Okay, I saw a bunch of a bunch of questions from YouTube. Let me go through them. Is now a good time to go all in for Oracle? Um, I don't advise so. It's not a good idea to go all in any company to start with. But Oracle, especially, we don't have too fond of a view on the stock because we think that too much of its backlog is dependent on OpenAI. So Yeah, no. Is the previous tech sector unit trust falling? Did basically there's another question that asks, did the unit trust value fall due to profit taking? I mean, the value fell in line, basically in line with the market. Um, and the market fell very sharply in, I think, latter half of June as well as July, because of a whole lots of concerns. I mean, there were so many concerns. Yes, it's a large part of it is profit taking because you had tremendously strong performance starting from April, heading into May and into a bit of June. So a lot of that was profit taking, and a lot of it was fears of, oh, Chinese models, coming in and disrupting the economics of frontier models. But again, like I just said earlier, um, there are different roles for each of the tokens. Um, and also there were fears about how it was the peak of the cycle, especially in memory, which is why memory kind of corrected the sharpest, um, because DRAM and NAND prices have peaked. But we we think, I mean, ASPs, what the companies are telling us is that the DRAM and NAND ASPs are only going to continue increase. Yes, at a they may not be growing at 100% quarter on quarter or year on year anymore. But if anything, we think growing at low single digits or mid single digits year on year is very healthy, and we think that should be the case. And that is what warrants memory companies to trade at a more respectable valuation and not be too cyclical like they were in the past. So anyway, I've digressed. And just going back to your question, yes, the unit trust value fell because of profit taking, both in the unit trust itself, but also the broader market when investors were aggressively pulling out of semiconductor stocks. Yeah, no AI bubble. Today is a very different environment. You see real earnings across the tech stack, from software, hyperscalers, and especially the semiconductor companies, and multiples are not nowhere near stretch. What are my thoughts on physical AI? Should we expect a similar bottleneck with components with building these robots? Yeah, physical AI it's not here yet, but I think when it comes, there's going to be a lot of attractive opportunities across the physical hardware supply chain, especially those companies that have to do with robotics. And obviously, when the time comes, we will ramp our exposure in our portfolio to those. But today, very much of the exposure we have is to cloud AI. And I think for physical AI to really take off, the economics have to make sense. I mean, robots is just an example, right? But of physical AI. But robot cost today, I would think, is probably still too high for mass adoption or even for enterprise adoption. Um, so we would need the economics of that to make sense for wider adoption. What is the benefit of buying this fund versus buying individual stocks um, in the US market? Well, well, no one's stopping anyone from buying individual stocks from the market. But the benefit of this fund is that if you don't want to pick stocks, if you don't want to monitor the day-to-day news of the sector or of individual companies, then you can leave the money to us, and we will do the investing for you. Essentially, that's why unit trust exists. And the benefit is as well is that we probably would buy into some stocks that you may not have heard of or you may not understand as well. And yeah, you may know the top 10 stocks. I think most people do, but there are a lot of interesting names in the tail end that you don't see. And then that's where the benefit of buying into this portfolio comes in play. Let me see any other questions. What do you think about the software companies? Do they have more upside compared to the hardware companies like memory companies, data centers, and chips, etc.? Um, no, we still think based on how we're positioned, we clearly think there's more upside in in the chip space and in the hyperscale companies. But that's not to say that there's no upside in software. We clearly think there's still a lot of upside, else we wouldn't have such a big position in it. Um, but I guess for software companies, it investors still need time to really believe that they won't be disrupted. Yes, we're seeing over the last in recent quarters, we're starting to see AI driving an acceleration in some of their revenue or some of their other financial metrics. But there's still that lingering concern that it's just the growth rates will just fall off a cliff because AI will finally disrupt them and software companies will go to zero. There's still that lingering concern behind a lot of the investors' minds. So I think it will take time for investors to finally accept, okay, fine. AI is not going to kill software. In fact, AI could be a tailwind for the software companies. And we just need a few quarters of the software companies basically proving the haters wrong and showing that AI is actually beneficial for them. Again, not across all software, but across a select basket of within software. And I think that's where, and I think that's where, again, going back to someone else's question earlier, that's where we come in. Um, we have we have a software analyst here within our team, and we can leverage on the software analyst expertise at Lazard, and together that expertise should help us pick the right stocks. Okay, I have time for one more question. Is there value in investing in the optical transceiver and new cloud players at this juncture, or has upside been priced in? Um, no, I think there's still upside. Although these two groups of names are definitely, I would say, higher beta, especially the neo cloud players. I mean, just partially as a function of greater retail participation, as and also generally the neo cloud players are more leveraged compared to, say, the hyperscalers. But let's touch on optical transceivers. I think that's a very interesting space, and I think there's still upside there. Because as I mentioned earlier, to fully utilize the GPUs or whatever computing capacity you have, you really need very good networking. And as we move towards even more and more powerful GPUs, you need tremendously more powerful networking. And the current technology used for networking is largely still copper-based. And to really lower the latency and increase the communication speeds between the GPUs, we are entering an era where you increasingly need optical technology. So yes, a lot of the uh, Lumentum and Coherent and all these optical names have rallied very strong, I think, since last year. And yes, to a certain extent, it has priced in a lot of upside, but they have corrected a lot as well recently. And so I think that's a very healthy reset to expectations. And I think as more and more investors slowly understand how important opticals transceivers are and generally optics are for networking, I think their investors will again have come to appreciate the importance of these companies. And new cloud players, I would think that the upside for them would come from, well, by the way, I don't cover these companies. So there's I have limited knowledge on these companies, but from what I know, the neo cloud companies that have access to power right now are those that are more attractive because it doesn't make sense to have a bunch of GPUs or compute lying around if you don't have if it's not plugged into the power. So if you're a neo cloud player with power supply and you're able to secure compute capacity and everything else around it, like networking, then you're in a pretty good position and you should continue to exceed expectations, kind of like CoreWeave did in the most recent quarter. I think we're at the top of the hour. Um, so I will hand the floor back to Mark, and I hope you guys have found this insightful, and I hope I've tried my best to answer a lot of your questions, and I hope I've done a decent job. Thank you.
Yeah, thank you. Thank you very much, Mr. Jim Lim, for your presentation and help address our participants' question from Zoom and YouTube. So to all participants, if you have any further questions regarding global tax or funds and all, you can just drop us an email at investhelp.my@fundsupermart.com, and our client investment specialist team will address for you accordingly. So before we wrap up, I would like to highlight that ongoing promotion on FSM1 offering zero sale charge plus a 0.3% bonus unit for every 1,000 net investment up to 600 ringgit until 28 August. So still got about 9 days to go. Okay. So when you invest in a Maybank Global Sustainable Technology Fund, which is have a three classes, MYR, MYRH, and USD classes. So for more details, you may find the campaign promotion in the FSM1 portal. So thank you, Mr. Sim. And again, ladies and gentlemen, hope this section added value to your investment decision and investment journey. And thank you. Have a great moment.
Thanks, Mark. Thank you, everyone. Have a good evening.
Okay, thank you.